Hello friends, James Stevenson back with part 13 in my Tesla earnings forecast video review series. Unlucky number 13, or lucky number 13, depending on your perspective, will be the last video in this series where I talk about my pretty charts. After this, it'll all be boring or fascinating numbers against a white background. Let's check in with my co-host Loki, who is curled up in bed, not doing all that much, and I will share my desktop and we'll pick right back up where we left off at the end of part 12, showing you this SG&A detail. There's one more chart here that probably I should have covered in the previous video because I was talking about stock-based compensation, so watch part 12 before you watch part 13. I'll just tack on to what I was saying and show you this chart. I don't always include this chart anymore because it's kind of history at this point, right? So at the beginning of Elon's 2018 Q1 performance award package, he had made very little progress towards achieving any of the goals that were outlined in the plan. So a very tiny amount of expense hit the income statement during that quarter, and that makes sense, right? But then as the quarters went by and as Tesla's revenue improved and as Tesla's earnings outlook improved, Tesla was profitable in these quarters, he started inching closer to achieving more of those planned goals. And then in 2020, when the stock really took off, they had to catch up a lot of expense over the next few quarters because the market capitalization of the company was racing towards $650 billion, the top end of the goals outlined in Elon's plan, so fast. And I predicted that that was going to happen. I thought, even though these were the expenses that had been hitting historically up until 2020, I had in my forecast that they were going to start being big numbers over the next, 5 or 6 quarters. And I put out a long thread about that with all dog GIF animations. So I might try and dig up that old thread and leave it in the video description or something, if I remember to. If I forget to, leave me a comment and say, hey James, you forgot. Here's one from the 25th post of the thread. Rather than just showing earnings per share, this chart shows each category of revenue and expense per share. I'm forecasting $1.02 of non-GAAP EPS in Q3, roughly flat year over year. Not bad, considering the loss of so many production weeks to line upgrades. All right, what are we looking at here? This is a visual that combines regular Excel workbook cells with 2 charts that I put side by side. So I've got one stacked bar chart here for revenues, and right next to it I've got another one. It's a stacked bar chart for expenses. And this top bar here, this 90 cents, isn't an expense at all. That 90 cents you can see in the table over here is GAAP EPS. That is earnings per share. So Tesla isn't spending this money. Tesla is retaining this money as retained earnings. Then there's 12 cents here that's non-cash stock compensation expense. This is just accounting for giving your employees some shares of stock as part of their compensation. Tesla doesn't have to buy those shares from the open market to give them to their employees. Tesla can just create those shares and give them to the employees. Why does it appear as an expense? Because as an investor, it changes the total number of shares outstanding, right? So the more shares of the company get created, the less each share is worth, all else being equal. So ceteris paribus is the Latin for all things being equal. The more shares you add to the ownership pie of a company, the smaller everyone's piece of pie gets as a percentage of the total. I hope that makes sense. The company doesn't change in value as a result of adding more shares. You can't make the company more valuable by creating more shares. So when you do that, everybody's percentage ownership gets watered down a little unless you offer them the chance to buy more shares and then they're still paying for it, right? All right, so what's the revenue breakdown showing here? Well, we've got automotive revenue of $6.04 here. I have it labeled in two places. I have it labeled over here and I have it labeled over here. Maybe I should figure out how to put the color legend on top of these. I'll think about it for a future video. So what's the 55 cents? That is the energy division's revenue. And then all other is 75 cents. Again, these are per share. All these amounts are, if you take the dollars, the billions of dollars, and you divide them by the billions of shares of stock, how many dollars per share is it? So $6 per share worth of automotive revenue, selling cars and leasing cars. Then 55 cents worth of energy products, so generation and storage products, and 75 cents of other stuff, everything else combined. So the service centers and Tesla insurance and the store merchandise and lots of other stuff. All right, what about automotive cost of sales? That's your biggest cost per share of $4.70. So the difference between these two numbers is the automotive gross margin per share of $1.34, right? Then energy division cost of sales, 46 cents. You don't make quite as good a profit margin on the energy division yet. Tesla is going to get better at producing Megapack at scale, and as those economies of scale lever against the fixed cost of that program, you should see improving energy division gross margins. Next, all other cost of sales at 68 cents. That's this block right here, relative to this one. So you don't make lots and lots of money on services and other and insurance and stuff, but you do make some money, which is good. Then Tesla spends 21 cents per share on research and development, 28 cents per share on everything else. I do have 8 cents worth of deferred tax asset benefit in here, which is why I grouped a bunch of that stuff together. So that's these, and that leaves you with those two that I talked about first, the 90 cents worth of GAAP earnings per share and the 12 cents worth of total stock-based compensation. If you add those two together, that's where you get the $1.02 of non-GAAP EPS. That's the one Wall Street cares about. They say, throw out the stock compensation, nobody cares, it's non-cash. Tell me what the non-GAAP EPS is. I'm forecasting $1.02, we'll see what we get. I may or may not restate my forecast. Usually my rule is that if I get the production and deliveries really close, I don't bother reforecasting any of the dollar amounts, because what I could do is change my forecast to make it less accurate, right? If I was already that close on production and deliveries, it's a real possibility. That's what happened last quarter. My production and deliveries forecast was awful close, so I didn't bother doing a reforecast before earnings were released after the production and deliveries report came out. Okay, what's the next tweet here? Tweet 26 in the thread. Here's the most straightforward chart in my forecast thread. Tesla used to lose money, not anymore. There you go. So that's the most recent 5 years worth of Tesla non-GAAP EPS. So I said I'm expecting about $1. About $1 was the average. $1.02 may have been real close to the average quarterly profit from last year, from 2022. What happened this year? Tesla is selling more units, so the volume impact is favorable on earnings, but they also had to reduce prices by a lot. So those price reductions mean there's an unfavorable rate impact offsetting the volume increase. So there's good news and bad news in 2023. The good news is Tesla's selling more cars. The bad news is Tesla's charging less per car this year than they were last year. So the revenue per vehicle is lower, and that leaves less profit per vehicle at the bottom line. But then you multiply that by more vehicles, and you get to about the same earnings dollars. That's the oversimplified version of what happened. Of course, there are many dozens of variables that determine exactly how much your earnings are going to be, and I only mentioned 2 of them just now. which is a bit of a reductionist fallacy. But if you want to know what the two biggest influences are on 2023 earnings relative to 2022, that's the cause of change. Favorable volume, unfavorable rate. Next is tweet number 27, or post number 27 in the thread on X. Tesla's detractors and short sellers like to emphasize how much automotive gross margin Tesla has lost since reducing prices, but the reality is Tesla's margins were much better than Toyota's at last year's prices. Now they're merely a little better. Let's check this out. So what's the yellow line? Let's talk about that first. The yellow line is Toyota automotive gross margin. Okay, so Toyota automotive gross margin has remained in the 17 to 20% range at all times over the past 5.5 years, is what this chart's telling you. What's the mountain range in the back? Well, you got two different things happening. You have Tesla automotive gross margin excluding regulatory credits as the darker blue, and then the lighter blue, or maybe it looks gray to you, I don't know, don't ask the colorblind guy. That's the portion of Tesla's total automotive gross margin contributed by regulatory credits, which have very little variable cost associated with them. So you got two different ways of looking at Tesla's automotive gross margin. The more conservative way is to exclude the regulatory credits, and then the higher of the two is, no, what was it in total, including the regulatory credits, right? So you can see how those have trended over the years. In 2021 and the early part of 2022, Tesla was really charging a lot per vehicle, right? Tesla had a lot of pricing power in 2021 and 2022 towards the beginning of the year. So they were charging a lot and people were paying it, and that made for higher gross margins up to about 30%. So at this point in time, Tesla had 10 percentage points or more worth of automotive gross margin above what Toyota was earning. And so then when all these price cuts started happening, the Tesla Q army said, well, it's over now. Tesla's going to go bankrupt because they've had to cut their prices by so much. Well, they weren't thinking about it this way. They didn't make this chart first before they came up with that assessment, because yes, the automotive gross margin percentage has declined, but it declined from world-class, industry-leading gross margin percentages to still pretty good automotive gross margins, better than Toyota. I mean, a lot of people uphold Toyota as being the standard of greatness in the automotive industry, right? They do still produce a lot more vehicles than Tesla does for now. At some point in, I don't know, 5 years, maybe that won't be true anymore. Maybe Tesla will be producing more vehicles than Toyota by then. And if it's not 5 years, maybe it's 10 years. Who cares, right? So, yeah, this is where Tesla is now. Do I expect Tesla to keep cutting prices a lot from where they are now? No, I don't think so. I think there will be enough demand to buy Tesla's products at the rate they can produce them at current prices, or, somewhere in that range. Maybe they'll cut it a little bit more. Who knows? But a good chart, I thought, would be helpful for more people to be aware of, so that you're not left with a mistaken impression that Tesla's gross margins are now worse than average. They're not. They're still better than average. They're not the best in the world, like they were a year and a half ago. But, if interest rates come back down again, they could be in the future. Tesla's target market isn't the same as the Mercedes-Benz, BMW target market, right? So a lot of people who want to buy a Tesla can't afford to spend more than $400 a month on a car payment or whatever, and that's never really been true of Mercedes-Benz or BMW. You get what I'm trying to say. All right, next is post number 28 from the thread. This chart shows how big a deal Tesla's 40 gigawatt hours per year Lathrop megafactory will be for total Tesla energy storage deployments including Powerwall once ramped, and Tesla plans to build another 40 gigawatt hour per year megafactory in China. Let's take a look at this chart for a second. So this is megawatt hours deployed. This is the volume metric for the Tesla energy storage business. So for a lot of these years, the majority of the megawatt hours deployed were Powerwalls and Power Packs. I'm not even sure Tesla makes Power Pack anymore. That was the one in between Powerwall size and a Megapack size. Maybe they still make Power Packs. But that was most of what you saw back here. And then Tesla started making Megapacks, but they were only making them with spare cells when they had them out of Giga Nevada, and not on a dedicated purpose-built line either. So the production rate was slow, so they weren't able to sell a lot in any of these quarters. Then we get to the end of 2022, so about a year ago, this steady increase of megawatt hours deployed began. So this is the most recently reported actuals. You can see in the bar underneath the time period axis. These, from here back, are all actuals. And you can see what my forecast is for the future is to continue this upward ramp of megawatt hours deployed. And it'll really start to take off toward the end of 2024 if Tesla has their megafactory in China built and producing megapacks for export to the rest of the world and for sale domestically in China. So good news there. And the next chart kind of shows you how that translates into dollars. Those energy storage gigawatt hours become billions of dollars worth of sales for Tesla, and as output from the megafactories rises, economies of scale and local sourcing of parts and raw materials will improve profitability. And this is the last of the pretty charts. The last 40 posts are my detailed model, and I will compress those last 40 posts into only 3 videos. They're going to be long ones, probably, unless I'm really skimming through them quick. All right, Tesla Energy Division per share metrics. So you got revenue in yellow here, and you got cost of sales in red. And when the red line is above the yellow line, that's bad news. Like, Tesla was losing money on the energy division in 2020 and a little in 2021. So around the first half of last year, the revenue really started pulling away from the cost of sales. So the revenues were higher consistently. And that's been true with the actuals up until Q2 of 2023, with a really good separation here over the last couple of quarters. And I'm forecasting that to continue as both of these lines will rise. So the more your revenue goes up, the more product you're moving, the higher your cost of sales is going to be. But you hope that the climb, or the slope of this line for revenue, is greater than the slope of the line for your cost of sales, because the difference between the two lines is your gross margin contribution from that division. So a lot of profits will be contributed by the Tesla Energy Division in the future if what I'm forecasting is about right for Megapack to grow a lot. And there's certainly enough demand out there. Tesla just needs to execute on the supply chain logistics and the manufacturing output. And that's my video. So with that, we'll check in with Loki one more time to see that he is up and thinking pensively about my forecast and my charts. And I will outro and say, if you've enjoyed today's video, don't forget to click the like button on whatever platform you're watching this. And if you haven't subscribed to me, and if you're watching me on YouTube, you can do that by clicking a subscribe button over here for free. But thank you to everyone who chooses to support me, for those of you who can afford it. If you can't afford to support me, don't do it, please. But if you can, if your finances are in great shape and you can afford to support me, I would appreciate your help. be it that through Patreon for $4.20 a month, on Twitter for $3 a month, 69 cents per week, or on YouTube, as my executive producers Kathy Kitchler and Rebellionaire.com did. Thank you, and I'll see you in the next one.